The financial history of the modern world is punctuated by moments of rupture, singular events where the established order dissolves overnight, leaving chaos and wealth destruction in its wake. We collectively remember 2008 as the defining economic trauma of our generation, a year when 465 banks collapsed, millions of homes were foreclosed upon, and retirement accounts were incinerated in a bonfire of toxic mortgage-backed securities. It was a systemic failure that reshaped the global economy and permanently scarred the psyche of the American investor. However, if you are currently trusting the stability of the banking system based on the recovery of the last decade, you are operating on a dangerous obsolescence because the mechanisms that caused the great financial crisis were not removed. They were merely obscured, repackaged, and allowed to metastasize into something far larger and more volatile. What is approaching in 2026 is not a repetition of 2008, it is an escalation, a convergence of financial forces that will make the Great Recession look like a practice run. And if your capital is currently sitting unsecured in a regional bank, or if your investment strategy is predicated on the stability of the traditional financial order, this is the most critical warning you will hear. This is not speculation or doom-mongering, but a forensic analysis of a collapse that has already been set in motion, governed by the immutable laws of mathematics and market cycles. And the scariest part is that most people have no idea it is happening right under their noses, because the mainstream narrative continues to preach resilience even as the foundation rots. To understand why 2026 is the terminal date for the current financial cycle, we must strip away the noise of daily stock market fluctuations and look at the structural tectonics of the banking system. The question most skeptics ask is, why now? Or why 2026? The answer lies in the synchronization of three specific catastrophic failure points that are currently hurtling toward each other, creating a perfect storm of insolvency that the Federal Reserve and the FDIC will be powerless to stop without destroying the currency itself. The first and perhaps most visible pillar of this impending collapse is the commercial real estate time bomb. Specifically the $1, $5 trillion wall of debt coming due between now and the end of 2026. For decades, commercial real estate was the golden goose of banking collateral. Office towers in Manhattan, retail centers in Chicago, and mixed-use developments in San Francisco were considered as safe as treasury bonds. Leading banks, particularly small and mid-sized regional banks, to load their balance sheets with loans backed by these properties. However, these loans were originated in an era of near zero interest rates, when money was essentially free and property valuations were sky high, a world that no longer exists due to the fundamental shift in how human beings work and shop. The return to office mandates have largely failed. Remote and hybrid work models have decimated the demand for urban office space, and the relentless march of e-commerce has hollowed out physical retail, causing vacancy rates in major metropolitan areas to hit historical highs, while the cash flow generated by these properties, the rent paid by tenants, has collapsed. The mechanics of this disaster are unavoidable because commercial loans are not like 30-year fixed-rate residential mortgages. They are typically balloon loans with shorter terms, often 5 to 7 years, meaning the principal must be refinanced at the end of the term. The property owners facing this refinancing wall in 2026 are walking into a financial slaughterhouse because they took out loans when interest rates were 2% or 3%, but now they must refinance at 7%, 8% or higher, creating a mathematical impossibility where the cost of servicing the debt has tripled while the income from the property has halved. We are already seeing the warning shots in cities like San Francisco, where prime office buildings valued at $300 million in 2019 are trading hands for $60 million today, representing an 80% destruction of equity that is not an isolated incident, but the new standard for urban real estate. Who holds the bag for these losses? It isn't the massive, too big to fail banks like JP Morgan Chase or Bank of America, as they saw the writing on the wall and began offloading their commercial real estate exposure years ago. Rather, the bag holders are the regional and community banks, the very institutions where millions of Americans keep their business payrolls and personal savings. These banks are drowning in toxic real estate paper, and when the defaults begin in earnest in 2026, these banks will find their capital buffers wiped out instantly, rendering them technically insolvent right now and merely waiting for the loans to mature for the corpse to be discovered. If the commercial real estate crisis is a visible fire, the second factor is a silent, odorless gas filling the room. The crisis of unrealized losses sitting on bank balance sheets, a direct result of the Federal Reserve's aggressive interest rate hiking cycle starting in 2022. During the pandemic, deposits flooded into banks as the government printed trillions in stimulus, with banks, needing a place to park this cash to earn a yield, did what they are taught is the safe thing to do by buying U.S. Treasury bonds and agency mortgage-backed securities. Well, these are effectively risk-free in terms of default, because the US government will always pay its debts. They are highly sensitive to interest rate risk due to the inverse relationship between bond prices and interest rates. When interest rates go up, the market value of existing bonds with lower coupons goes down. Because the Fed raised rates from 0% to over 5% in a